Fixing the US government's debt problem with Bitcoin is an idea that's been around for years, but it's one that was never really taken seriously, and that's mostly because it wasn't clear how exactly this could be done.
How to do this?
That's until earlier this month, when a Bitcoin-focused think tank proposed a solution that would not only increase the demand for bonds, but could also cause Bitcoin's price to explode higher. Today we're going to summarize this solution, see whether it could work, and explain what it could mean for Bitcoin and other cryptos. My name is Nick, and this is a video you can't afford to miss. The report we'll be summarizing today is titled, quote, Bitcoin Enhanced Treasury Bonds, an idea whose time has come. It was published by the Bitcoin Policy Institute and is actually a policy brief, which is basically a policy recommendation. We leave a link to the full report in the description for you to come back and read later. Now, the report begins with something I'm sure a lot of you had forgotten by now, and that's Trump's executive order to create a strategic Bitcoin reserve in early March. The report highlights the fact that this gave Bitcoin legitimacy as an asset, specifically as a store of value asset like gold. The report's authors underscore the fact that the executive order instructed the Treasury Department and the Commerce Department to find ways of accumulating more BTC without costing the taxpayers money. They explain that the Bitcoin bonds described in their report essentially build on those instructions. Not only that, but the Bitcoin bonds described in the report will also create demand for US bonds at a time when the government needs to refinance its debts. To put things into perspective, the US government will need to refinance roughly $14 trillion of debt over the next 3 years. This is a bigger problem than you think, because interest rates right now are much higher than they were when the US government initially borrowed this money, and this means its debt would have to be refinanced at a much higher interest rate, resulting in more tax revenues going toward paying interest. And this begs the question of what Bitcoin bonds are and how they could help solve this problem. The answers are that Bitcoin bonds effectively combine US Treasuries with Bitcoin, with the US Treasuries offering a small yield and investors being compensated for this small yield with higher Bitcoin returns. If you're confused, don't worry. The report gives a simple example to explain how exactly this would work. First, a Bitcoin bond would be issued, and 90% of this bond would consist of US Treasuries offering a low yield, such as 1%, and the remaining 10% of the bond would go towards accumulating Bitcoin. Logically, issuing a 10-year Treasury at a 1% yield would make it possible for the US government to refinance itself well below the current level of interest, which is around 4 to 5% at the time of shooting. Obviously, bond investors would normally not accept such a low yield. They would want a higher return. And that's where the Bitcoin comes in. The rationale is that 10% allocation to Bitcoin will provide the returns that bond investors would otherwise get through yields. The report specifies that investors in Bitcoin bonds would get 100% of the upside up to 4.5% compounded, and 50% of any gains beyond that. As for the remaining 50%, this would go to growing the US's strategic Bitcoin reserve. Of course, the reason for providing 100% of the upside up to 4.5% would be to practically act as a 4 to 5% yield that investors would demand from regular 10-year treasuries. For context, Bitcoin's annualized return has been 100% since it launched, so a target of 4.5% annualized is certainly achievable over the next 10 years. The result would be the US refinancing its debt at a significantly lower interest rate, accumulating large amounts of Bitcoin without costing taxpayers money, and simultaneously pumping up Bitcoin's price. And by the way, if you're enjoying this video so far, then be sure to smash that like button to let us know. And if you're not subscribed to the channel yet, you can change that right now by hitting the subscribe button. And you may as well hit the bell as well to make absolutely sure you don't miss our upcoming videos. Now, this begs the bigger question, and that's why investors would want to invest in Bitcoin bonds. And the answer has to do with its unique risk-reward profile. Bitcoin bonds are low risk because they mostly consist of US Treasuries, which are technically the safest assets you can have in the financial system. Notably, the way the Bitcoin bond is structured means that even if Bitcoin was to go to zero, bond investors would technically get all their money back when the bond matures, because that 1% yield on the US Treasury portion would make up for the Bitcoin that was lost. And this is where things get very interesting.
It's very interesting.
In theory, bond investors getting all their money back when the Bitcoin bond matures would not be worth it, because chances are that this money would be worth less than it was when adjusted for inflation. However, this assumes that the 10% allocated to Bitcoin would go to zero during this period. In practice, it could be argued that the only way Bitcoin would ever go to zero during this period would be if there was deflation, in which case the Bitcoin bond would theoretically be worth the same or even more in real terms by the time the bond matures. But so long as there's inflation, Bitcoin should continue to rise. And that's just because Bitcoin has a fixed supply, whereas fiat currency has an infinite supply. The more that governments and central banks print money, the more that Bitcoin will appreciate, all else being equal. So unless there's something like a quantum attack on Bitcoin, BTC probably won't be going to zero. And you can learn more about how quantum computing could affect Bitcoin by checking our video right over here. Moving on. To quickly recap. Even if Bitcoin went to zero, Bitcoin bondholders would get 100% of their initial investment back due to the 1% annual interest rate on the US Treasuries within the Bitcoin bonds. The only scenario within which Bitcoin would go to zero is if there was deflation, which is objectively unlikely. And even if there was deflation, then Bitcoin bondholders could actually end up with more money in real terms. And this ties into the reward side of the equation. You'll recall that Bitcoin's annualized returns since its launch have been over 100%. It goes without saying that this figure is inflated by Bitcoin's early years when its price went parabolic. So let's be much more conservative and assume a 10% annualized return from now. With a 10% annual return, the value of the 10% Bitcoin allocation in a Bitcoin bond issued today could theoretically grow by 2.6 times over 10 years. The result would be a 126% return when you factor in the 1% earned on the 90% allocation to US Treasuries. And I should note that this is actually lower than just holding 100% in 10-year Treasuries. For reference, a normal US 10-year Treasury bond yielding 4.5% annualized would be a 155% return at the end of the duration of the Treasury. The catch is that the calculation that we just did with Bitcoin is extremely conservative. There's also theoretically no limit to how high Bitcoin could go, whereas there is a limit to the 4.5 interest rate on a fixed treasury bond. In other words, the rewards of holding 90% US Treasuries with a 1% yield plus 10% Bitcoin could be exponentially higher than just holding 100% of US Treasuries yielding 4.5% annualized. As a cherry on top, the US government gradually grows its Bitcoin pile, further restricting the supply and increasing Bitcoin's price. More on that later.
Oh, sorry, I just had to take a break from that video to check the Coin Bureau deals page. You know, the one place you'll go to get exchange sign-up bonuses of up to $100,000 and trading fee discounts of up to 70%. Or how about discounts on hardware wallets, as well as exclusive altcoin alpha in the Coin Bureau Club? Well, more information in the description. Now, back to the video.
Anyways, in the next part of the report, the authors assess the financial benefits that Bitcoin bonds would have for the US government. They start by noting that if the US government was to refinance $2 trillion of debt using 10-year treasuries at the current rate of around 4.5%, then the US government would be stuck paying $90 billion per year in interest for the duration of the bond. If the US government was to use a 10-year Bitcoin bond, however, the interest rate would be just 1% on the US Treasury portion, resulting in an annual interest payment of just $20 billion. Over the course of 10 years, the government would save $700 billion in interest expense, which is very big. To give you a sense of just how big this is, the authors note that the $70 billion per year that would be saved is how much it costs to finance the whole entire Department of Homeland Security. And the authors also stress that these savings could be achieved without raising taxes or cutting spending. Next, the authors assess how much Bitcoin the US government could accumulate because of the Bitcoin bonds, as well as the value of their Bitcoin stash in the future. As you can see, they provide a wide range of outcomes, from $800 billion to over $300 trillion over a 10-year duration. Naturally, the first scenario seems to be a bit more realistic, as it assumes a Bitcoin price of 1.25 million in 2035. The other scenarios are much less realistic, as they assume a Bitcoin price of $274 million per coin in 2035. It's safe to say that we would be living through some truly hyperinflationary times if that were to happen. Anyhow, under the realistic scenario, the US government would accumulate roughly 2.2 million BTC in its strategic Bitcoin reserve by 2035 thanks to the Bitcoin bonds. The US government currently holds around 200K in Bitcoin, so 2.2 million BTC would be an 11 times increase from their current holdings. With a Bitcoin price of around 1.25 million per coin, that would translate to over $2.7 trillion. It's important to note that this calculation assumes an average annualized return of around 36% for Bitcoin, which the report authors note is a conservative estimate. You'll remember that we used an average annualized return of 10% in our previous example. From the author's perspective, the gains will be much bigger. In fact, they believe that if the US government was to embark on a Bitcoin bond program between now and 2045, it could accumulate more than $50 trillion worth of Bitcoin that could be used to offset or pay off the US government's debt. And the authors also have a plan about how to further increase investor demand. And that would be to exempt Bitcoin bond holders from taxes, both on the yield from the US Treasuries and the returns from the Bitcoin. They note that this would make them a low-risk, high-reward way for Americans to build generational wealth, and they even calculated the potential returns. As you can see, the authors again present a wide range of returns, from 7% per year to 65% per year. And I'll remind you that the higher-end estimates assume a Bitcoin price of $274 million per coin in 2035, which is ambitious, to put it lightly. Even so, the author's conservative estimate looks good at first glance. The caveat is that this would only offset the 7% loss in purchasing power that occurs each year because of money printing, but we'll come back to that a bit later. Now, in the next part of the report, the authors attempt to assess the potential demand for Bitcoin bonds. They start by explaining the various benefits Bitcoin bonds have for different investors, such as easy BTC custody and compliance for institutional investors, diversification for foreign investors, and savings for retail investors. They note that 132 million American households could invest as much as $3K each. To be honest, it's not entirely clear how they arrive at this answer, but we suspect it has to do with this infographic over here, which shows that 20% of US Treasuries are currently bought by US households, with the remaining 80% being purchased by institutional investors and foreign investors. The authors assume that we will see a similar split for Bitcoin bonds, which is a bit of a stretch in our view. In any case, in case you're not convinced, the authors provide this handy infographic that breaks it all down: the savings, the upside, the amount of debt that can be offset, and the advantages for both retail and institutional investors of all kinds. All that's missing is the risks, which the authors address directly. They start with the elephant in the room, and that's that Bitcoin has historically been incredibly volatile, and that's precisely why they limit the Bitcoin allocation to just 10%. Any more than this could leave investors open to losses if Bitcoin went to zero, and any less, and they would result in much lower potential returns. To their credit, the authors do acknowledge another issue, and that's the fact that Bitcoin purchases associated with Bitcoin bonds would likely cause Bitcoin's price to rally a lot. And they argue that this could be mitigated through dollar cost averaging and over-the-counter sales. But to be honest, this is a bit doubtful. The actual speculation from investors about the Bitcoin bonds could result in lots of buys of Bitcoin on the spot markets. Then the authors talk about other, more basic risks, such as those related to holding such a large amount of Bitcoin in custody, regulatory risks such as classification of Bitcoin bonds as assets, given that they consist of security and a commodity, and the international and public perception of Bitcoin bonds. To mitigate against these risks and others, the report's authors recommend starting with a pilot program that could be launched by the President's Working Group on Digital Assets. And this pilot program would last for about 3 to 6 months and involve $5 to $10 billion to ensure that the Bitcoin bonds work as intended. Assuming the pilot is successful, the authors recommend that there be a, quote, policy and expansion period lasting for anywhere between 6 to 12 months, with Congress preparing any related legislation and the Treasury Department scaling up the Bitcoin issuance to $100 to $200 billion. Assuming this expansion period is successful, the authors then recommend a full implementation over the course of 12 to 24 months, targeting up to 20% of the US government's financing needs. And this would be done with the help of other key entities such as the Federal Reserve and various market participants. After reviewing a few other non-financial benefits that the Bitcoin bonds could have, such as showcasing America's leadership in innovation and competitiveness, the authors conclude by reiterating that Bitcoin bonds are a logical continuation of the Trump administration's pro-crypto executive orders and goals. They also provide a 5-point plan for policymakers to make Bitcoin bonds a reality. Direct the Treasury Department to analyze their feasibility, assess the ideal balance of US Treasuries to Bitcoin as well as the ideal yield on Treasuries, draft related legislation, namely around taxes, design a strategy to integrate Bitcoin bonds into the strategic Bitcoin reserve, and assess their effectiveness once they've launched. All we're wondering is why someone wouldn't just opt to hold 90% US Treasuries and 10% Bitcoin. That way they could earn a 4.5% yield instead of a 1% yield, and they'd also be able to capture 100% of Bitcoin's upside rather than just 50% above the 4.5% annualized return included in the Bitcoin bonds. This would surely be much better, no? And this brings me to the big question, and that's what Bitcoin bonds could mean for Bitcoin and the broader crypto market. The answer ultimately depends on if they're ever implemented. For the time being, this doesn't seem likely, but for the sake of education, let's assume that Bitcoin bonds launch in the coming months. Besides the speculative pump that would accompany their initial launch, the effects they would have on Bitcoin and the crypto market more broadly would fundamentally depend on demand. The more demand there is, the more Bitcoins will rise, as 10% of every Bitcoin bond would go towards buying BTC. And what's fascinating about the Bitcoin bonds is that, unlike the spot Bitcoin ETFs, the BTC backing the bonds would not be sold whenever someone sells a Bitcoin bond. The only time that Bitcoin would be sold would be to pay out the yields to Bitcoin bond holders. In practical terms, this means that Bitcoin bonds would significantly restrict Bitcoin's circulating supply, which is a bit of a double-edged sword. On the one hand, this would make Bitcoin's price rise even more, which could incentivize more Bitcoin bond buyers. On the other hand, though, this would make Bitcoin's price extremely volatile, which could result in Bitcoin bond holders panic selling if Bitcoin was to crash because of, say, a publicly traded company dumping Bitcoin. Now, as for the wider crypto market, Bitcoin bonds could be bullish for altcoins because of the effects that they could have on interest rates. If there was lots of demand for Bitcoin bonds, then the yield on US Treasuries would eventually fall. This would cause long-term interest rates to fall and risk assets to rally. With all that said, though, we don't believe there would be much demand for Bitcoin bonds if they were launched, and that's because of the two things we've mentioned earlier. The first is the conservative annualized return of 7% for Bitcoin bond holders, a return that's just enough to offset currency depreciation. Newsflash, but if you're not invested in something that's earning you more than 7% per year, you're falling behind. And the second thing that could dissuade investors from buying Bitcoin bonds is the fact that they would be better off just buying a combination of US Treasuries earning 4.5% and just holding some Bitcoin. The annualized returns would be much higher over a 10-year period, even if the value of the US Treasuries fell because of inflation. If you think about it, what this report shows us is that having a barbell strategy of US Treasuries and Bitcoin is one of the most optimal from an investment perspective. Again, this is not a strategy you need Bitcoin bonds for. It's one you could easily do yourself, and you could even tweak the parameters as you see fit. Better yet, you could go 100% crypto by combining a yield-bearing stablecoin backed by US government debt with Bitcoin as the barbell strategy. The best part is that this barbell strategy is available to anyone, anywhere, and it could have the same effect as Bitcoin bonds, namely lowering the US government's debt burden. And that's because the more stablecoins there are, the more US Treasuries get bought. And you can learn more about how stablecoins could subsidize the US government spending by watching our video on that right over here. And if you're not subscribed to the channel yet, you can do that right over here. That's me for now. Thank you very much for watching, and I'll see you again soon.